That's the structures, because then we got to talk about when you do these things and what's expected in each stage. So Joe, we're going to have to go faster this evening. All right. So in the seed stage, as I said, it's kind of a range of capital. Typically, we're talking about that being a pre-prototype, like just an idea, maybe a sketch on paper, or you have a prototype. You have something that you can show a customer, but not really anything for them to buy. Usually no revenues or a few customers. Very high chance you're going to have, that's a 0x. Very high chance you're going to lose all your money as an investor. And the way I talk about to entrepreneurs about the angels that invest in that early seed stage is that they're really patrons. They're taking a flyer on your company, right? That's the term we would use. Yes, they may want their money back, but if they lose that money, they're fully expecting that's fine, right? They're not going to feel poor if they lose the money they hand you. Okay, so what you would do in a seed investment would typically be a convertible note or a safe. Those are the two most common things, because again, priced equity is uncommon for two reasons. One, this is almost always angels investing in the seed level. Angels often don't know how to do valuation, right? We're on Angel Investing 201. We still haven't told you how to do it. And the entrepreneurs typically don't know how to do it either. And nobody wants to negotiate it. So you just kick the can down the road, do it in a convertible form, do the valuation later. I've seen recoverable grants at this stage. This is a good time for that kind of money to come in, or just straight up grants. And this is a great time for companies to join an accelerator. And so the accelerator will help them get everything in shape, maybe give them a little bit of money and put them on the path to get to the startup level. And so example of this would be ArcLight. ArcLight takes any plastic waste, turns it into artificial rocks. They're useful in construction. I brought them into Fledge when it was just an idea. We can call this prototype, but these were handmade plastic prototype rocks, hand pressed, right? You sell these things in the tons, and literally in the whole world there was 3 handful of these. So there was proof of concept, but not prototype. And so we brought them into Fledge. We invested in this company. We invested with our revenue-based equity. And then they went off and sold convertible notes. They raised $1 million of convertible notes to get into production. Another good example of this would be Cold Hubs. They're in Nigeria. They do solar-powered cold rooms in the marketplaces in Nigeria. Another fledgling. When they came in, they had one prototype that they had built and brought around from market to market to show it off. But they never ran it for more than a day or two in any one place. And they were trying to raise a few $100,000. They in fact got some funders to show up, but they were really early in terms of the seed stage when they came through. More often than not these days, the kind of companies that angels see and accelerators see are actually already in the startup phase. So time has moved on. This happens in the world where, Apple back in the 70s was seed stage when they got funded. They wouldn't get funded these days. They would have to find some customers first. So startup phase, there's at least a minimal viable product that's for sale, MVP, read the lean startup if you don't know that term. There's usually some customers, paying customers. In the software world, they might not be paying, but you might have 10,000 non-paying customers. You still have a chance as an investor that this goes to zero, pretty high chance at that. And usually what the money is for real, when you step back and look at it at a distance, usually what the money is for is to find product market fit. That's a term of art that just means you're still trying to figure out what the market really wants. You're not sure that there's going to be profits yet. You have to grow a bit and tune the product before you're on a path to profits. That's typically where it is. But in terms of African startups, a lot of the companies I find in the startup phase are already break even. They already have good customers. They already know what they're doing. They're just not quite early growth yet. There's still some kinks to work out. There's still some issues like we have a gap in operational capital twice a year every time there's a season. You can't grow. You can't get to your growth phase until you've solved that problem. Okay, anything I missed?
No, I think this is great. A lot of times, there's so much variability here in what's going on. Investors obviously like to just pour gas on the fire if the company's already figured out, like, hey, we
Yeah.
can spend $1 to get a customer, and the customer's worth $10 or whatever it is. But frequently, it's there's so many unknowns that you're betting on a team. You're betting on a team.
Yeah. Yeah. So that's a good way to put it. So in the startup phase, you're betting on dream and team, not on numbers yet. So again, most common thing to see here would be more convertible notes or safes, more recoverable grants, more accelerators these days. And then if there's an equity round, we would usually call this Series Seed now, or something like that. Series Seed is a set of open source documents for preferred equity priced round. I know we've hired Joe to do some for our fledglings.
Yeah, they're really nice. I think the Series C documents reflect a trend, which is that in the old days, like when I started practicing law, like every law firm had some set of documents, and so like if you did a financing, you'd have big law firm A maybe prepare the documents, send them over to some other law firm, and everyone would fight over the language in the documents. And now what's happened is all these documents have been basically open sourced and published and updated by recognized authorities. And then people, like if you revise if you start with the standard form documents, plug in all the blanks, make your changes, the lawyers actually send red lines against the baseline documents to their opposing counsel so they can accelerate the review of the documents, so people know exactly what there is to talk about, if anything. And so anyway, it's interesting. It's interesting times for that sort of evolution of practices.
Yeah, and this has also lowered the cost. So when I was an early
Substantially.
entrepreneur, it would cost $5,000, $6,000, $7,000 to do a priced round in the 90s, right? With 90s dollars, and now it's what, $4,000, $5,000, $6,000 in 2021 dollars.
Yeah, I mean it has. Yeah, I think. Yeah, it's just it's a good practice. If you think about it, like people want to do transactions, people don't want to screw around tangling about like things that they don't need to tangle about. So yeah, the open source, go find the kind of the industry standard approach to things is it's really nice because it helps deals get done a lot faster.
And how many of these do you know of? Series Seed, Techstars has one, YC has one. How many different sets are there?
Oh, so for fixed price financings for smaller rounds, the Series C document set is sort of the industry standard.
Okay.
And then I would say the industry standard for larger fixed price financing rounds is the NVCA document set. And then in the early stages, you've got the Y Combinator Safe is really popular. And you've also got like some other organizations like 500 Startups. The Alliance of Angels in Seattle maintains a form of convertible note on its website. I mean, you could find like different forms of agreements. But I would say like the YC Safe.
Even the big high price startup law firms like Cooley has a website with a whole bunch of docs on it for free.
Yeah. And that's smart. You want to work if you're trying to raise money as a founder. You definitely want to try to use the industry standard approaches to things because those are what everyone understands and everyone wants to do. Everyone wants to do the industry standard thing almost always. I mean, not always, but almost always.
And I'll point out for those of you who are investing in Africa, because we're on the Africa cohort here, I've found very little difference between American securities law and Nigerian, Tanzanian, Kenyan, Ugandan, Rwandan, Zambian, Botswanan security law. Like the British really did just set the tone for everybody. And so literally just pull up Series Seed, hand it to a lawyer in your home country. It should not have to change much. There's some boilerplate in there that mentions the US security laws. You just take that out or replace it with the boilerplate that mentions your security laws. And now you have a set of preferred equity docs that have been used tens of thousands of times. All right, so example of where we do startup investing in terms of priced rounds. Zoeto in Malawi. Turns out I did a search. I think there's only 5 investors have ever done investing in startups in Malawi, including me. All institutions. I haven't found an angel yet in Malawi. So we had this company, Zoeto. They were a tiny little company. They had a couple of little vet shops in northern Malawi. And then we had the ability to buy their distributor. So when we bought the distributor of all these vet supplies, we did a priced round. And so we now own 20 something percent of Zoeto. And then back then there were only 3 investors in the whole country. And then a fourth one showed up and invested in Zoeto and diluted us down. But a European investor came in. All right, moving on to early growth. So again, big giant range, right? This almost totally overlaps the previous one with a bigger zero at the higher end. Early growth is where Joe said, you at this point you might know that if I put $1 into marketing, I'll earn $1.50 or $2. You might know exactly how much it costs you to get a new customer. It might cost you exactly $123 to get the next customer, because that's what it cost you to get the last 100 customers. So you go spend 123, you got to raise it, but then you go spend $123, and you know that each customer will break even after maybe 18 or 20 months. This is where, like, cold hubs now, because they're in this stage now, they know that it's $22,000 to set up a cold hub in another market, and that it takes 14 or 15 months to break even. Like, we know this for a fact because it's been done 20 times. That's where we are in early growth. Same thing with East Africa fruits. We know that if we get 3 more delivery trucks, here's how much the revenue will grow, right? Based on the expectation we can find more demand, and finding demand in food and ag in Africa is easy. Often you'll find that the companies are at least cash flow break even. Cash flow break even. All the bills get paid, right? Maybe not everybody gets paid a market rate salary yet. Maybe some other things that, on paper, maybe it's not profitable because of some accounting things. But in terms of cash flow, the bank account doesn't go down. The bank account stays even or goes up, or is actually profitable, and the bank account gets bigger every year. I don't like dealing with accountants and their ways of talking about these things. And in the US, we might be in early growth where they're not break even, but they have a plan and they're going to show you how this money is going to get them to break even in the next, by the end of the use of the funds, the next 18 months or maybe even 24 months. And so I put that in there because you'll find this in Africa too, in the tech space. There's this thing called VC scale companies that are purposely burning money in order to grow as fast as they can. And so they're not aiming for profits, they're aiming for growth. And so they may not be profitable, but you're going to believe in them anyway because there's some huge endpoint coming up. And in the early growth phase, what you'll find is a lot more debt. So this is the phase where they know what equipment they need because they have it. Often they need the next size piece of equipment up, or 3 of whatever they have. And so this is where you might do debt, but it's collateralized on the equipment. This is where that operational capital comes in, like AgroSupply. So every time they add a farmer, they need to borrow more money just for 3 months, but they need to borrow more money from somebody. That's it. That's an issue that pops up. It could be that this is the point in time where they need a facility. And in Africa, the answer is often that you got to build a facility. You can't just go rent one. Because in Nigeria, you got to put down 2 years rent. Like in the US, you got to put down like 1 month's rent or maybe 3 months rent if you're young. But in Nigeria, or I think in Ghana too, you got to put down 2 years worth of rent up front. You might as well buy a piece of property and build a building for that. So often we're doing that in our African companies. Seems weird. It feels weird to me as an American, but that's just the way you do it in Africa. This is often where you'll do priced round. This is kind of where those things convert, right? That you should, by the time you get to early growth, have that big round of equity that converts everything over into equity. And this is where all these alternative structures start showing up. And again, a good example of this is all the companies in Africa Eats, not Africa Eats as a whole. That's an alternative, but pretty much every company in this crowd is in that early growth phase. They're almost all profitable. We know that if we put $1 in, we're going to get at least $1 of revenues back out. And so that's why we formed this company. And that gets us to the end of Angel Investing 201. So this is everything we covered today, which is a lot.